I am Puneet Khurana with my very good friend Manish Thawan, and together we bring you Stoic Podcast Series. This series is started as an initiative by stoicinvesting.com to bring the best minds of investing to teach their wisdom, irrespective of their investment style or philosophy. Learn the various viewpoints, choose the nuggets, and then develop or enhance your own investing style. Today we have with us Gaurav Sud. Gaurav, a Shimla-born IIT Delhi and IIM Calcutta alumnus, was an obvious choice for me for this podcast today. I met Gaurav 5 years back in Mumbai in an investors meeting, and we connected because of our love for reading. But in subsequent interactions, I figured him to be a very sensible investor, but most importantly, I have figured out that he is very versatile and very open in his investing approach. One proof of that is, unlike other value investors who shun the so-called financial weapons of mass destruction, Gaurav is extremely open in applying various option strategies to amplify his returns. Without further delay, let's listen to Gaurav now.
Today we have with us Gaurav Sud. Puneet already introduced him to the audience. Gaurav, welcome to the show.
Yeah. Thanks, Manish. And hi, Puneet.
Thanks.
Right, Gaurav. Let's start from the start. I just wanted to know, talk us through your journey. How did you start? Who introduced you to the industry, to the world of stock markets, and how has been the experience so far?
I guess my interest in the stock market started pretty early in life. My father owned some shares which he bought of the so-called FERA companies in the late 70s and 80s when the government forced many of the MNCs to divest their shares.
Okay.
And there was a controller of capital issues who used to control the price at which the IPOs used to come.
Yeah.
So, and some of the IPOs came pretty cheap. So my father had bought in some of those shares, and the allotments were pretty low. Like there are stocks like Colgate, there's Hindustan Unilever,
Right.
and then there was this Hero Honda also. Incidentally, was one of the issues he applied to. So, anyways, so those annual reports used to come, and one of the things was I was quite an introvert, so I just liked reading a lot.
Okay.
And what used to happen, I would run out of reading material after a point. So these annual reports would come, and I just used to glance on it, and some of them were interesting write-ups. So that's what got me interested in the businesses.
Interesting.
But that was it. I really didn't understand what the process was all about. So this kind of, so I was kind of interested, but not really active in it anyway. And so when I started my engineering, what happened was that in the library, and incidentally, I studied at IIT Delhi only, which is where we are doing the podcast.
Right.
So in the library, I discovered this book called Warren Buffett Way.
Okay.
Yeah. So this was this book by Robert Hagstrom. So just read through it, and I just thought about it, and intuitively I just found that this is a pretty interesting way of thinking about a business, that you think of yourself as a part owner of a business.
Mm-hmm.
And the fact that companies over a period of time, if the economy GDP is expanding, the companies are bound to expand.
Mm-hmm.
And if you focus on a certain quality of companies, so that's kind of what got me interested. So having read it, I read through a lot of books on technical trading, but somehow at that point it never clicked for me.
Right.
So since I was in IIT third year, and we were deciding, so I decided that I wanted to be in this space. So decided on an MBA.
You were doing which specialization in IIT?
I was in electrical engineering. So most of the people were thinking about going outside India, but for me that was something that I didn't want to do.
And this is which year? Sorry.
This was 1997.
97. Third year. Or the final year.
Third year would be 96. So I passed out in 97.
Okay.
So that's kind of what got me interested. So I got through to IIM Calcutta. That was known for its finance, and there I focused largely on the finance space. So I also did my internship at UTI.
Okay.
So
It was a big deal at that time.
that's when I discovered the capital market database
Okay.
and how you could run queries.
Right.
So this was in 2000. Sorry, not 2000, 1998. Yeah.
Okay.
So that was very interesting. I did this entire project where I backtested, say, hypothetically, if you had bought stocks in 95
Right.
and based on certain filters, which was low P's or low price to book,
Right.
and then see where the prices were in 1998 at that point of time.
Okay.
And the results were quite amazing. Matlab, you could compound money at more than 30%.
And this was
across,
like a 3-year
multiple market cap ranges. Yeah.
This was a 3-year backtest, 95 to
So
98.
I took the data from basically earnings 5 years before 1995.
Okay.
So use those earnings to say which are the cheaper stocks in 1995,
Got it.
and then see how did they perform over the next 3 years in terms of the price.
Right. Right.
So I was not churning the portfolio. I just said that one took a buy decision in 1995
Right.
and where the stocks were in 1998. So clearly there was outperformance to the index.
Right.
So that kind of hooked me in and got me interested. But again, since I had read Buffett, I just thought that I don't want to be in the Mumbai where you'll get distracted by so many other things.
Interesting.
So I took up a job with KPMG and came to Delhi. So that's how I started, and then I worked with KPMG for a couple of years. Then moved on to Wipro, and Wipro worked, so got a lot of international assignments. So that's the first time I got exposure to what was happening in the US and kind of those kind of things.
Okay.
But your KPMG and Wipro had nothing to do with the capital markets per se.
No, they had nothing to do with in Wipro. I was part of spending part of time to look at M&A acquisitions for Wipro in the BPO space,
Okay.
but none materialized during the time I was there. So, and then finally then I moved on to another company called WNS, and so by WNS I was kind of getting bored because the roles that I was getting were largely middle management roles where you were managing people.
Right.
So at WNS, even though we were doing like equity research report support for Deutsche Bank
Right.
in Europe, but I wasn't the one who was going into those models, and I wasn't the one who was looking at various sectors. I was just managing people who were doing that.
Got it.
So that came out kind of boring, and so in 2007 I kind of decided, and this opportunity came where a set of people I knew, they had acquired a company, gave an open offer, and they needed a guy who could be the face of the company.
Okay.
And that's how I joined. In terms of my incentives, I got quite a few warrants in that.
Which company is this?
This is Asian Oilfield Services.
Okay, this you joined in which year, you said?
This is towards the beginning of or towards the end of 2006.
2006. So you were with WNS for a pretty long time. With Wipro for a long time. I'm assuming you started in 2000, right? So 6 years of work.
Yeah, Wipro I was in from 2003 to 2002 to 2005, and then I was with WNS.
Okay, fair enough. Yeah.
So
Asian Oilfields.
yeah, Asian Oilfield. So it was pretty. It was heady days for the market, 2007.
Yeah.
Right.
So we got the process of allotments done, and then we went out and marketed the company. So we ended up raising quite a bit of money, so close to 80 crores in 2 installments.
Okay.
Right.
And then used that to scale up the company. We won 2 big orders, one from ONGC, another one from Oil India. But after having won them, a couple of shortcomings came into play. One, we realized that the orders we have won were in very difficult terrain. One was in Nagaland, the other was in Mizoram.
Okay.
So the one reason that we won the orders is because ONGC guys did not want to do it. So
nobody else bid for it.
Nagaland has militancy issues. So effectively, once we started out there, there were a lot of issues around that.
Right.
And also, what we realized is that before the company was took over, it was a small setup with turnover of about 12 crores. And suddenly we were aiming to make it a 100 plus crore company. So the processes, the mindset was just not there.
Right.
Plus, it was a project management business where you make money if you are efficient in your project management.
Okay.
And we were not so efficient. So we made money for a year, but after that we started losing money. But anyways, so that was what happened with the business. But in my case, after 2007, we raised the money. My warrants had a lock-in, and I wanted to monetize part of my. So the share price had moved from 22 to close to 400 rupees plus.
Wow.
Okay.
And I wanted to monetize some of my investments. So I converted my investments, but I distinctly remember that the day I converted, just 8 days after that, the Lehman announcement came through.
Oh, you got so lucky, man. You got amazing. What timing? You're a trader.
So anyway, so that was perfect timing. So all this during this time on the sides, I was buying shares and I believed in long-term investments. I read a lot around Buffett and Graham, and I thought that works. And in the interim, I got very lucky with a stock called Unitech, which actually was one of the reasons I even thought about quitting my job. So I was living in a.
Make a lot of,
pardon?
I'm saying Unitech has made a lot of people quit their jobs.
Yeah, at that point of time. So
yeah.
So yeah. Anyways, so my thesis on this is 2003. And I'm living in a Unitech property and just scanning through stocks, and I came across this company and as I read through it, they talked about owning 56% in a hotel. This is the Radisson Hotel on at Meroli. So and I did some maths and the hotel itself, as per me, was worth more than 200 crores. So 56% of 200 crores was more than 100 crores. And this company was trading at a market cap of 42 crores. And virtually with no debt.
Okay.
And so that's what made me buy it. Plus, I was living in a Unitech property, which was a 300-acre project. And I know at what price they were selling all those. So whatever maths you do, so I just failed. So anyways, I kind of entered it at those 50 crore market cap, and then it started rising. So I think what happened was the son Sanjay Chandra came back from the US. He realized there's a lot of value in the company, and what he did was what I think he did was that with some other investors, he bought out the two other partners in the company.
Okay.
And then actively marketed the stock. So what effectively that did was that this stock from a 50 crore market cap to the peak in 2006 hit 60,000 crore market cap. So it was, from the point I saw it, was 1,000 bagger.
Wow. So I have an interesting question regarding this, Gaurav. Although we are jumping ahead from our normal stream of questions, since we're talking about Unitech here, and you said you were able to ride it, it became 1,000 bagger. What I wanted to know is what helped you ride it? Because if you're calculating it through the valuation per se, it must have been overpriced long ago, right?
Yeah. So one, I did not get the entire benefit of 1,000 bags. I started selling it in lots, but I think I sold around 7-8 lots. So effectively the return I got was closer to 90x of my original investment. So because I was selling it in lots, and the last lot I sold was close to 400 times the original buy price. So it all added up.
Right.
And obviously, I wasn't. But after some point, I was just riding the wave. So if you can say, because I remember distinctly from 100 rupees to 2000, the stock moved over circuit. So you
You could not even sell it.
largely didn't have to do anything. So.
Right.
So that was pretty interesting, and I thought that okay, I put very small money and I made this much. I need another stock like that, and my life is made. And that's how I got into. I thought that let's quit our job. So
Okay, jumping again ahead slightly, but since we know a little bit about your work with other companies,
sure.
was that other company, other stock Ashiana for you? The second.
Yeah. So that was largely the case because.
Will this only run us through your association with how you got associated with Ashiana and how Ashiana became a part of your portfolio first and then part of your.
So 2006, I've exited Unitech, and I was thinking at what to do with that money. So I came across actually at that point of time came across this small company which was hardly traded, and but the balance sheet looked very clean. So at that point of time it was difficult to get hold of an annual report.
Right.
So somebody passed on the annual report to me, it's saying that look at it, and I got really very interested in it. And that's the time I spoke to Ashish Chugh. So, and he said that he also liked the stock. So we tried to meet the promoters.
Okay.
And it was very difficult for the initial 3 months. They wouldn't respond or anything. And finally, I was able to reach to the MD posing as a customer. And then I told him the real reason I was trying to get in touch. But he said that why do you want to speak to us? We don't even consider ourselves listed. So I told him that the fact is you are listed, and now that you are listed, just allow me to meet you. So anyway, he agreed. So they had an office at Masjid Mohd. One of their office was out of one of the houses out there. So they were working out of the ground floor and the basement.
Okay.
So I met them, and I loved the guy. So this was a guy called Vishal Gupta. So.
Okay.
He had just joined the business about 4 or 5 years back. The business itself was founded by his father, who started from Patna and then moved to Bhiwadi. And anyway, that story is in the public domain, so many people would know about it.
Right.
But anyway, I really liked the guy, and then on the next visit, I also met the father. And between the two of them, I was just amazed at the kind of thought process they had. So one, they were not driven only by money. They genuinely wanted to keep their customers happy, and that was the first time I was exposed to this kind of a thought that profit is not the only motive.
Interesting.
So, and their thought process is you keep your customers happy and everything will follow. So that kind of a thought process. Having bought a house from Unitech at that point of time, I just realized that the builders don't treat their customers very in a very nice manner once the sale is done. Before the sales, they really model them, but after the sales, all the chasing has to be done by the customer.
Right.
And these guys claim to have a very different mindset.
Wow.
So this what is impressed, and that's the point I started buying into the stock and gradually bought into it. It was highly liquid. It almost took me 2 months just to buy my initial position, and that's kind of my entry point. So that is where I came in as an investor. So once I came in as an investor, a year passed, and the stock had doubled. But when I compared it with Unitech and the kind of valuations they had, I felt that like they were at least 50 times cheaper than Unitech.
Okay.
So and it was difficult to get in touch with them. So finally I got another meeting, and by this time they had moved to this Saket district center into the new office.
Okay.
And I finally met them and I told them that I think you are severely undervalued, and the only thing I would suggest is that you communicate your business model better. I think it's a very different. Yeah, the other very interesting aspect of the business model is they had virtually no land bank, no investments in land.
Okay.
So and their philosophy was very interesting. They said that land is inventory to us. If we are able to sell our inventory, then we'll always have the wherewithal to buy new inventory.
Right.
And this was very, very contrarian to what all the other real estate developers said.
Considering land as an asset.
So they said that land is a finite asset, grab whatever you can because later on it's going to be much more valuable and you might not be able to buy and lose your edge.
Sure.
So, but these guys said that, one, I don't want to block too much money in the land. And maybe their thought process was driven by the fact that they had not too much money to start with.
Right.
Then they had a direct sales model. They don't sell through brokers. They have their own marketing and sales team, and that directly reaches out to the customers.
Sure.
So given all that, I thought that you have a very different model than all the other guys that I have seen, and why don't you talk about it? So the standard response from their end was that we don't even consider we are listed. The IPO came in, I think, 92 and they 94, and they had raised about 1.2 crores out of that. So they said that we hardly raised any money for what? But it's not that we want to hide anything, but it's just that we don't think so that there is any objective. So anyway, we went back and forth on this for another 6 months, and then the younger brother.
And by this time you were buying the stock.
I bought the stock, so whatever I had bought the stock. So.
And this was at market.
See, another defining feature of my investing career is I've never averaged up. I've averaged down, but I've never averaged up till a year back.
Okay.
So I used to take all my positions right up front.
Okay.
So finally, the brother came back, and then I got a call from them that you were talking about we have to do something. So I met him, and Varun had come back. He had studied in New York University, and then he had interned or worked for a year with Citigroup in their bonds division.
Yeah.
So he understood the power of capital markets. He was much more comfortable with it. And we both kind of hit off pretty well, and he said, let's start. So that's how the whole exercise started.
Okay.
And when I say started, what we started doing is started working on their corporate presentation. So that was the first step.
Right.
Then we gradually moved from a corporate presentation to a quarterly presentation so that we could give updates. And the other big challenge was to get their business model explained to other people. So almost from 2008 till 2012, my biggest challenge was to get any big institutional investors to even agree to meet us.
Okay.
So they said that the market cap does not fit our bill, real estate mein to yaar chor log hain, किसने क्या करना है.
But what was the market cap at that point in time?
Market cap till 2012 was, I think, was less than 200 crores.
So you built up a position somewhere less than 100 crores even.
When I built the position, it was how much, I think about 13 or 14 crores.
13, 14, okay.
So we're already talking a 10 bagger here.
Okay, but
No.
That moved on to.
This is a 100 bagger for me. So,
I know that. Yeah.
But this position was built in 2006 or 7.
This was built in between 2006 and 7.
Okay.
Right.
So, but I never bought a share. So, yeah, we scaled up, and that's how. And then suddenly after 2012, it was kind of a tipping point where suddenly I had stopped calling people, and people started calling me on Ashiana.
Right.
So maybe we had reached out to enough HNIs, and then finally in 2013, Professor Bakshi's that lecture in MDI, of which a video was made, I think that was a big turnaround point where the larger investor community started thinking about the company in a different way.
Right.
So after that, it was the entire thing built its own momentum and worked out. So that's how the entire thing worked.
You're still associated with them as the...
Yeah. So I'm work as a IR consultant with them, and I have a paid retainership with them. So.
Okay. So, one question I always have is that by the time you are, learning the process, so to speak, you try to reach out to different kind of people who have different kind of philosophies, and some of them make sense to you. You told us that Warren Buffett's philosophy made sense to you from day one, but were you at any time motivated by or maybe influenced by some other philosophies and you tried your hand at that, or it was just straight away?
See, I from the start of my investing career, I've always focused on the screeners, running queries in screeners. So that was an interesting starting point. Screeners would always give me ideas to start working on. And in the interim, as I said that I also read a lot about technical analysis. So read about these turtle traders and what all they did. So even tried my hand at it, but I just realized that it's just not for me. One thing I realized is that when I reduce the time horizon to very short periods, I'm a very bad investor or a trader, whatever you call it. So I tend to panic. I tend to do things that logically I should not have done. So a case in point is, so Lehman happened in 2008.
Right.
And I was almost, I think, 90% of my net worth was pure stocks.
Okay.
And that stock portfolio then corrected by 70%.
Do the math.
So.
And I'm assuming Ashiana was one part of
Yeah. And Ashiana by itself, Ashiana at one point was close to 65. I don't remember the exact, but more than 65% of my portfolio, just one stock.
Wow.
And then that stock corrected 91% from that price.
Ouch.
Wow. And so what? Ashiana went from 14 crores to even 5 crores or what?
No.
Or
by
that
time it had hit 200 crores.
200 crores. Okay. So it went from 200 back.
So it went all the way from 200 crores to about 30 crores or so.
And you didn't sell a single share?
No, I didn't sell. But the point is, I didn't buy any. Mm-hmm. And I remember that in 2009, November of 2008, I liquidated my stock holding, which had already corrected so much. I liquidated and made an FD. And I still carry that FD today to remember what the way I behaved at that point of time. Wow. So it was a terrible phase for me. So my black swan happened at that point of time.
Were you married at that time?
I was married. Yeah, I got married in 2004.
So what was your wife's reaction to that?
She didn't know. So what all was happening? so yeah, one of the things is my wife really didn't know my money issues in terms of the kind of money that was there or the kind of things that.
Were you a poker player or what? You went home with a straight face?
No, yeah, my wife wondered. Obviously, they knew that I'm full time into the stock market, so the pain is there. But nobody had an idea about the scale of pain that was there.
Wow. So maybe they were saying, okay, the pedigree will take care of.
Yeah. So this is another interesting aspect. So when I quit my job and having a IIT IIM pedigree, I always thought that, come what may, मैं जो मर्जी कर लूँ, ultimately I can always go back for a job. Yeah. So this was always on the back of the mind. So 2009 March, Feb, I'm down and out, lost quite a bit of my net worth. The only asset I had which was of value at that point was the house I was living in. And I was thinking, and then I talked to my father and he could clearly make out the stress I was going through. So he said that, why don't you go out and look for a job? And then I thought, why not? So I spent the next 4 months looking for a job from Feb to July 2009. I only got one offer, and that too in Calcutta, which I didn't want to take. So by July, the realization set in. Yeah, matlab you burnt your bridges.
Yeah.
So having been out of the job market for almost 3 years, and the fact that you are looking for a job at a time when the world is thinking that everything is going to collapse on itself. So that brought a big change in my mindset. There was a level of urgency which I never had in my life, and that set me reading a lot. So almost the next 8-10 months, I read like crazy. I read a lot about it, and that got me involved in two different things which are a big part of my strategy. One is the so-called risk arbitrage, and the other is around selling options.
Sure.
Right.
So that's the two aspects which, besides the long investing I do, are a big part of what I do in life now.
So selling options, can you slightly explain that?
So selling options is
How does it fit your investment?
I'll get you started. One was that the correction, and by the way, I was running a few managed accounts for friends and family, and there were about 23 of those.
Sure.
And till 2007, I had compounded money pretty well. But then when the correction happened, what I realized is that in long-term investing, you are making a hypothesis, and then you are waiting for the hypothesis to play out. You have absolutely no control on the outcome.
Sure.
Right.
And post the correction, I realized that I have absolutely no control of how the market is going to behave a day later, or a month later, or a year later. So on what basis can I give assurance to others that I can compound your money?
Sure.
Fair enough.
So that mindset just made me, obviously some of the people were unhappy that they lost some serious money. So I returned all the accounts. For one account, I also repaid some of the losses back to them. But effectively, I closed all the accounts and decided not ever to manage money again. Since there was not much money to do anything with, so I was reading a lot. So I started reading what people in US do. So one came across this options. So options as a strategy, I broadly understood what options were, but never. I thought this is for traders. What's my interest?
Sure.
But then I came across this article, and I still remember this article. There is a website called fullyinformed.com. So there was this lady, a Canadian lady, who was like in her early 60s, who had been kind of selling options for almost 30 years. And she was living her entire life building through it, and she had the time to post 4 articles a day, extensive articles, and she would have these Excel sheets where each of the trades was captured step by step. So, and 60 something lady.
Wow.
We're not talking about Karen, the super trader, are we?
No, not the Karen. She's a Canadian.
Okay.
So the website it's now a paid website. Then it wasn't.
Okay.
But the website is fullyinformed.com.
Okay.
So, and I read a lot. That time it was free, and I read a lot about. So one of the articles that she wrote, and which clicked very well with me, was the fact that he says that obviously there are option sellers and there are option buyers.
Yeah.
So the option sellers should think of themselves as people who are selling insurance.
Right.
So this metaphor itself clicked very well with me. So what an insurance company does is that it sells insurance to multiple people, and then once in a while a claim comes that is much more than the insurance premium which they have to pay.
Right.
So, and then I had read this other statistic there where they said that in a 40-year study in the US, they had seen that of all the options, more than 85% options expire out of money.
Worthless, yes.
So at zero value. So connecting the two, the fact that this lady made a lot of money, and there was this third hypothesis that I had. 2009, the volatility was high, the premiums were high. I thought that the premiums you are getting for selling that insurance are pretty high.
Right.
And so why not take a benefit of that?
Okay.
So I thought of myself that why don't you sell options, collect the premium, and gradually see how the kind of returns. So the initial 2 months, I got some good money. So even in terms of the gross money, the money I put at risk, I made almost 20% of that in just 2 months. So I thought one can compound maybe 50-100% a year on these.
So I'm presuming, I'm sorry to interrupt, Gaurav. Since you said 2009 was a bad year, and you basically
2008 was a bad year.
2008 was a
It
bad
was
year.
Financially, but 2009 was a time when I was doing all this reading and other
Okay,
things.
okay. So, but you went through literally some kind of capitulation, right? Where the
Yeah, absolutely. So that had radically changed my mindset. One, I had this fallacy. One fallacy that immediately I realized that I had. So Warren Buffett used to say that 99% of my net worth is Berkshire Hathaway stock. So I always thought that if he has 99% of his net worth in stock market, why can't I have 85-90% of my net worth in that? I'm young.
Right.
I need to compound my money. But what I didn't realize is that if a black swan event happens and suddenly things go gaga, his 1% is still worth $200 million. But my 10% is just my house.
Right.
So and having hit on the remaining 90% would impact the way I was living life.
Right.
And that is a realization that dawned on me at absolutely the time when everything had happened, which was even much worse than my worst case scenario.
Right.
So I had not even envisaged that something like this can even happen in my life.
So does that change your view?
So one, I returned all the money that I was managing.
Sure.
Second is I wanted to think of strategies which were counterbalancing my long only stock investments.
Sure.
So and that's how I got into both these fields of risk arbitrage, one, and the option selling was the other one. So
Coming to risk arbitrage, I was actually sitting with, so there was a meeting in Delhi and Professor Sanjay Bakshi was there and he was talking about risk arbitrage and he said that in the initial years there was a lot of return, then there was little return in risk arbitrage and then there was negative return in risk arbitrage. Have you seen that kind of a thing happening to?
Surely, let me tell you, so 2009 I started on both of them. So 2009 to 2012, whatever I made the money in risk arbitrage, I used to lose more than that in selling options. So
But you were making money in risk arbitrage.
Risk arbitrage, every year since 2009 I've made net made money. I did not have a negative year.
By that you mean last year also?
Last year also.
Okay.
So obviously the returns, if initially 2009 was a great year for risk arbitrage because even in the open office the deltas were pretty high.
Yeah.
So I initially used to think that in risk arbitrage one can make 30-40% easily, but if you set your targets like 18 to 20% as your threshold target,
Sure.
then I think those can be achieved. Again, it's a function of how much my money needs to be put at work. But for anybody who have funds under say 5 crores can easily compound money at more than 20% plus.
Sure. And
Beautiful.
considering from 2009 to 2015, you have done all years positive. Has the percentage allocation to risk arbitrage drastically reduced, or is it still a significant portion, or what?
So I started risk arbitrage with very small allocation. One, my portfolio was anyway hammered down out of shape.
Sure.
So I started with a very small allocation. So maybe I started with less than 5 lakhs allocation to start with.
Sure.
And gradually, so the first 2 years I was just testing the waters. I would just do 100 shares, 1,000 shares, that's it.
Sure.
I only started getting comfort after the first 2 years. And then I started, so 2011, 12, 13, 14, all have been good years for the risk arbitrage.
So
I can't say that about options, but
So how's the options journey been like?
So option journey, so as I said that first 2 months I made 20% of the capital at risk.
Right.
And I was pretty bullish. Maybe I thought I'd found a holy grail way to compound money. So suddenly in options, so after the 2 months, I increased my allocation to 5x.
Okay.
And this was April 2009. And the strategy largely was I would take the bhav copy, end of day bhav copy.
Yeah.
Look at options which were out of money by at least 15 to 20% from the current market price.
Okay.
And see where the premiums were maximum.
Okay.
And then sell those calls and sell those puts.
And did you sell calls and puts at once, creating a strangle, or just
No, strangle wasn't a thought.
Okay.
I would just sometimes, because people selling puts was easier at that time, largely because people were afraid on the downside, so they wanted to buy protection for their holdings. So you got more premiums on the puts than the calls.
So you were basically selling naked puts.
So I was selling naked puts, but I was selling a lot of calls also.
Okay.
So what had happened is, after the crash of if you remember, we hit the low 2008 meltdown lows in Feb 2009, and then it rebounded very fast in 2 months.
Yes.
So because it had rebounded very fast, the call premiums also shot up.
Right.
And so in April, I sold more calls than puts.
Got it.
And then I transferred the same into May, and then I got totally screwed. So in May, basically the election results
I
came in.
love the way you built it up. So in March I earned through the selling puts. In April I sold calls, and in May I got screwed.
So
Yeah, I was
basically,
not positive ending, but
so basically, May the results came. The index was circuit up.
yeah.
So I had never seen a circuit up on the index.
That's not a nice way to see it. With
So-
sold call options.
So anyways, and then since I did my trades out of ICICI Direct, there was not much I could do. I had no margin in my accounts. Circuit up, I got an SMS that I need to pay in the money, otherwise the trades are going to be called off. And then I got a call, and they said that there's no way I can even arrange for a money, and in half an hour the trades were cut out at whatever price they had. So basically, my stock holdings, whatever return I got out of that rebound, I just lost out by selling those calls.
But I'm assuming that the things have gone better post.
Yeah, so I thought that basically this is like I was just like being the hen who was very happy that everybody is feeding me so well till the time they
The Thanksgiving
stopped up.
turkey, yeah.
Yeah, exactly, the Thanksgiving turkey. So anyways, so that forced me, and then I tried multiple things. Then I said, then I came to this view that, okay, let's not look for the highest premium in the calls and puts. Let's look at where I have a view on a stock.
Okay.
And that's where my journey about marrying fundamentals, of which I had been practicing for more than a decade, with the fact that if you could marry fundamentals on stocks at a price, and you still got the premium that you wanted, and start doing that. So started with that. But what I realized is that in any given year, and I'm talking about the next years, so I would earn out of in 8 or 9 months, and then 1 or 2 months would take away the entire returns, and much more. So each of those years, 2009, 10, 11, 12, 4 years, net, every year I lost money on option selling.
My next question is, what's the point then?
Yeah, so this was this was the tuition. Anyway, so one was that I was obstinate. I said that I know there is something to it, and there's a way to make money. It's just that I'm not getting it.
Sure.
So that was one thing I just wanted to prove.
What made you think that too? I mean, is there some people you know who have
Because I had read about this lady, and I said that she's been doing it so beautifully, and she claimed that she's been compounding money at close to 20% for more than whatever year.
But
So
that's looking like one sample set, and so it's equivalent of somebody picking investors because you've seen Warren Buffett return.
Exactly, but half the people get into the stock market after seeing Warren Buffett. Isn't that so?
True.
So anyway, so I was this, and then I was realizing that I was doing something seriously wrong.
Okay.
So then gradually, there was another person I work with, Rohit, and then because I was spending so much time reading and researching options, he also got kind of start getting interested. And then I had a guy who was kind of a sounding board, so I would throw ideas at him. It's kind of the tag team like you two are playing right now.
Right.
So we would discuss things, and then gradually after talking to him, I just realized that one of the fundamental things is I'm doing wrong is I'm basically putting all my margin money at risk right at the start.
Right.
So, and then I set a lot of, I read about these traders because obviously option selling is from series to series. So, and one of the things, because I read from, I think Ed Sequoia. Sequoia. Yeah. So, and one of the things he said that for you to be a successful trader, you don't put more than 1% of your total money at risk on a single trade.
Right.
So that set me thinking that what am I trying to do? And then I realized that many a times I have to cut positions when whatever position I have taken is at its worst. And many times I've been able to book a loss and then see the trade moved to exactly the way I thought it would happen.
Yeah, happens.
So anyway, so that what prompted. So this is 2013. I started reducing my position sizing.
Okay.
So say hypothetically, if I earlier started a trade with 10 lots, I reduced it to 2 lots or 3 lots and see what happened. So and then I started seeing the change in returns in my strategy towards the end of 2013. So now what I do is that I always take a much smaller positions compared to the maximum position I'm willing to take in a stock.
And even that maximum is well within your risk
management. So it's always see, one of the things that happened is I had promised myself that after 2008 meltdown,
right,
I will not have more than 60-65% of my net worth in stock market.
Fair enough.
So that prompted. So that has prompted me to have other assets. I now own a lot of debt also. So and I invested a bit more in real estate.
Sure.
So that gives me the comfort that only the money that I'm willing to lose, I am putting at risk.
Right.
So that is it. But since 2013, I've started making money in the options also, and that has got me more interested. And I'm trying to do a lot of deep dive into other things and seeing whether there are other strategies. So my strategy is largely around covered calls.
Right.
So where I buy futures in a stock which I at a price where I'm comfortable with the stock,
right,
and then sell at the money or slightly out of money calls on it.
Interesting.
Gaurav, I know you read a lot. So for the option trading, if you want to tell some resources for the readers, what would you suggest? So let's say if I want to learn about option selling, what is the starting point?
I see my big learning came from that website. It's called fullyinformed.com, and I think it's pretty, but it has a lot of content that is free also.
Okay.
But it's dated content. So the other thing is again I discovered was this whole sort of video channel which is the Tasty Trade.
Sure.
And they're all kind of videos, and I think many option traders in India are learning out of that.
Sure.
And then there are discussion forums that are there on Zerodha, which is kind of interesting.
Sure.
So, but books wise, there are many primers on options, but they are kind of primers. So they'll tell you 1,000 ways strategies, but how you play out. I think the best way to learn is to put your capital at risk. Theoretical reading won't take you and I think the mental construct is by selling options, you're selling insurance.
Yep.
So you have to think whether you want to be an insurance buyer or you want to be an insurance seller. So that mental construct helps. It really helped me a lot.
Right.
Sure. Now, I just want to discuss something on the stock side also.
Sure.
So far, your experience have been making good amount of money returns in very small cap companies. Is that the way you generally start out? Do you look for only small cap companies and then?
I'm totally, I would say, market cap agnostic.
Okay.
But I also strongly believe in the view that basically the trees don't grow to the sky.
Right.
So anybody which has a huge base will find it extremely. You can't think of Reliance being a 100-bagger from here.
True.
Okay, so anyway, so if you are thinking in terms of multi-baggers, you have to move into the stream which is like you largely have to take the top 500 companies out of the equation.
Right.
So and that's the stream. But now earlier my ideas were generated out of screeners and queries.
Sure.
But now my ideas is having built a network with I know quite a few people now. So now the idea generation happens by discussion among people, and whenever there are meetings, everybody talks about something that they like at any point of time, and that could easily become the starting point for you to dig deeper.
Sure.
But then, can you take us through your research process as to?
Okay.
So once, let's say, you understand the basic idea about a company, what is the next step you follow?
Okay. So one thing was when I worked with KPMG right at the start. I used to work on financial models.
Sure.
So for the first year, I was just doing financial models. So and the insight that came to me around that is, and we did a 1-month course just on modeling. What I realized early at that point of time is that financial models don't give you any particular insights. You're basically building those models to justify whatever you already have in mind. So half the times we used to get mandate from my promoter, my partner, that okay, this is the valuation. Now build a model to justify it.
Sure.
So
That's pretty honest, yeah.
Sure.
So that's frankly, my analysis does not do DCF. I don't do DCF because DCF valuation, there are 2-3 levers you can dramatically change the numbers.
Sure.
Right.
But I do try to track the cash flows for the next 2-3 years, and I don't like to think beyond 3 years. It's too difficult for anybody to try to even start predicting. Too many things can change.
Right.
So and another big change that happened was that earlier, because I was running queries and screeners, I tend to buy what was statistically the cheapest.
Sure.
Right.
So obviously I ended up companies with big asset plays or holding companies.
Sure.
Right.
And then I realized that unlike in the US, where there are catalysts or activists who would unlock the value, there is nothing that can happen out here.
Sure.
Right.
So that over a period of time has dawned on me that India does not have catalysts to unlock value.
And there have been cases you can count on your fingers.
Yeah. So even again, Professor Bakshi was involved in one, and he's sworn off being an activist ever again in his life. So.
Yeah.
So it's done. So now what I look at is the logic of GAP. So growth at a reasonable valuation.
Right.
So what I've seen in India, growth is rewarded over and above any other factor.
Right.
So as long as a company is growing fast, you can be rest assured it will command good multiples. So now if you get hold of a company which hasn't gone anywhere in terms of top line or bottom line, but you see there is a transition point either because something has changed in the industry or whether their capacity, a much bigger capacity is coming into play, whatever the reason is. Mm-hmm. If you catch those companies at that trigger point and just the growth itself,
sure,
can help the stock re-rate itself. So that is one important angle that I've tried to build into my analysis. The other is...
Can I just add a question here? So one observation here is that, and I can pretty much define it as a pre-2007 way of looking at things and post-2000, 2007-8 ways of looking at things. Initially, there was a lot of focus paid to the only P&L side of the whole thing. So if the growth is coming, no matter how bad the balance sheet is getting to get that growth, the companies were rewarded. One case in point could be Pantaloons of the world.
Mm-hmm. Or all those so-called infra companies.
Right. And they were rewarded pretty well. Do you see, and since you track these kind of companies, do you see a change in the mindset of the players in the industry now, in the market, where the value to the balance sheet have really started coming up? So now people don't really pay growth that much unless and until it is along with a good balance sheet management.
There's one big change that has happened is that earlier what used to happen is that if say a consultant like me or an investor like me goes to an XYZ company and then tell them that okay, you guys show growth and your stock can move 10x from here.
Sure.
And once in a while the promoters would agree to that.
Sure.
And then they would show the growth and show non-existing profits which were not there but they were showing it. Because what happened was that the whole idea was that okay, show profits for the first 3 quarters and then reverse in the last quarter.
Sure.
Right.
So and if the stock price moves in the first 3 quarters, then we all benefit.
Yeah.
Right.
So a lot of that happened.
Yeah.
So what I personally feel is over the last 10 years, SEBI has been a wonderful regulator. It has clamped down on all kind of malpractices that were there in the market. They have started punishing the so-called operators, the promoters who were indulged in these activities.
Right.
So the market today is a lot cleaner. I would say it's cleaner by a factor of at least 10x than what it used to be 10 years back.
Nice.
So that I personally feel has taken out a lot of so-called manipulation in the stock market.
Sure.
Mm-hmm.
And where just 2 days back, SEBI order came on Valecha Engineering, where the promoters and the company has been banned.
Yeah.
And the order is quite detailed. So if somebody is interested, so you know that SEBI is getting active, and then these kind of actions act as a big deterrent on anybody who wants to do this in the future.
Sets the example.
So this deterrent angle is also coming into play. So I think the balance sheets are a lot cleaner and people don't fudge numbers or don't fudge numbers to that extent. So that's one of the reasons that I think.
My question again is that do you think, let's say, if the companies try to do, even if they want to grow, but they are not managing their balance sheet very well, let's say receivables are increasing drastically, those kind of things are now being looked more vigorously?
See, one thing that has happened is that the market rewarded quality a lot more in the last 3-4 years.
Sure.
And those stocks have commanded the kind of valuations that we haven't ever seen in the past.
Sure.
Right.
So obviously that gives a signal to the promoters that many promoters now want to focus that their quality of disclosure, the quality of balance sheet has to improve a lot.
Right.
And again, I advise another company called APL Apollo.
Yeah.
Right.
And that company has also been growing. But one of the key advice that I gave to them is that with the growth, you also need to focus on your balance sheet.
Sure.
Right.
So quite a bit of cleaning up happened in the balance sheet, and post the cleaning up over the last 2 years, they've appointed Deloitte as an auditor. So now also see, the earlier auditor used to take 5 lakhs a year for the entire group.
Yeah.
Deloitte is taking 45 lakhs a year.
Wow.
So for a promoter to spend that kind of money,
Yep.
so you can realize that the promoter also started feeling that the market is demanding these kind of transparency out of them, and clearly the promoter is also rewarded. So if you see the again APL Apollo, the stock price has moved from 200 crores to now close to 1,500-1,600 crores now.
Right.
Sure. Okay, one more question I have with respect to this only is that take me through your selling process. you get into a company. When do you think about liquidating your position, selling your position? Is valuation a big criteria? A lot of value investors come out and say that they are guilty of selling out
too early.
Yeah. Yeah. Obviously, I fall in the same boat. But one of the big lessons that which has also started giving me comfort is that I have stopped selling in a single lot. I now break up my selling into 4 to 5 lots.
You do your buying also in lots, or you buy?
I have bought historically in one lot, but I'm trying to change that process also because I've been reading a bit from Ian Castle, and then I've been talking a lot to Ayush on this angle. So Ayush clearly changed his strategy where he started averaging up, and then he's got phenomenal returns over the last 3 years because of that.
Sure.
Right.
So that is something that I want to incorporate, but I except for one stock, I can't say I've done it for many. So.
Sure.
Right.
So, but selling clearly, I've over the last 3-4 years, I've developed a model. So, hypothetically, I'll sell 20% on the initial. What I tend to do is when I buy a stock, I have a price target in mind.
Sure.
Once it reaches the price target, I will sell 20% of it.
Sure.
And then every 10 to 20% rise on it, I'll sell another 20, another 20, another 20.
Sure.
So, hypothetically, if the stock even doubles from the price
Sure.
I've initially sold it at,
Sure.
I'll still end up getting 50% more than the stock price I initially sold it at.
Okay.
And sometimes during that high rising up, the stock will correct. So if it falls below my initial selling price, I may even buy it back again. So just it's not incremental buying of more shares. I'm just covering the shares I sold.
Sure.
I think this probably is the best learning because nobody else can teach us about the art of selling better than a person who has rode 100 bagger and a 90 bagger.
Sure. And 2 of them.
Yeah.
Or
Yeah.
there have been third, we don't know about.
No.
Okay.
So that's anyway. So that's you just need to be lucky to even think about a 100 bagger. But I think if you get your strategies right, and if you have an investing career of say 20, 30, 40 years, you'll definitely get your 10 baggers.
Right.
Sure.
So and once in a while those 10 baggers will become a 100 bagger also.
Sure. But as of now, your searching is not. So let me just summarize. You don't look for specifically small cap companies, but.
So I like to look at companies which are basically which haven't shown a sharp price appreciation in the last 1 year.
Okay.
So any company that has moved up more than 100% in the last 52 weeks, I typically wouldn't want to dig too deep on it. So one of the things that really excites me is to get in a so-called undiscovered. It could be a large cap also, but which hasn't moved. So that means the market is not interested in it.
Okay, sure.
Interesting.
Sure.
So many times out of the circle, many companies come through where they say that it is interesting, and clearly it's interesting.
Yeah.
But then the company would have moved 2x, 3x in the last 1 year.
Sure.
But historically I've given it a pass, but now I'm trying to get out of that price anchoring in my mind.
Yeah.
But I think I made the most money where
I'm the first one.
where I'm among the first few.
Right.
I should not be say the
Right.
I'm among the first few. So I don't want to get into a stock when there has been a sharp uptick.
Right.
Sure. So the only thing missing in the whole picture now is your portfolio management strategy. So first of all, how concentrated or how diversified you are?
So I've always, because I read Buffett, how strong I always had a relatively concentrated portfolio. So my filter is, I don't want more than 10 stocks in my portfolio.
Okay.
Fair enough.
So and in order to get the 11th stock, I have to sell one of the existing ones. So that itself makes a very tough filter for me to even think seriously about a stock.
Okay.
Right.
And is the position, so are the positions equally distributed? Like
Yeah, I like to my opening buying position typically is 8 to 10% of my long put.
Okay.
See, what has happened is my arbitrage portfolio has also grown.
Sure.
So arbitrage portfolio, there the logic is very different.
Sure.
You are looking at say 2 to 10% returns but you are focusing on velocity of returns. How many times you are able to churn that money within the year.
Sure. Right.
And there you can take concentrated bets.
Sure.
So if I said that minimum I want to allocate, say 8% into my long portfolio.
Sure.
I will not allow any stock in my portfolio to be more than 35% of my stock. So that this is learning from Ashiana. So if it starts crossing 30%, I'll start selling it.
Okay. And then shift it to your risk arbitrage portfolio, or
no? It's lying in cash. So I like sitting on cash now.
Okay. So how much cash you are sitting on now?
40%.
40%.
Interesting.
So are your cash levels defined by market levels in any way?
Yeah. So that's another level. So I read about this guy called David Swensen.
Yeah.
So he runs the Yale Endowment Fund. So he wrote this book, and Yale Endowment returns over the last 30 years have been among the top 10 percentile, if not the top.
Yeah.
So, and one of the big things he said that I have made my money not by picking individual asset managers or companies or assets, but the way I have made my money is by doing strategic allocation across asset classes.
Sure.
So he's a strong votary of mean reversion.
Sure.
So the whole philosophy is that suppose you have two asset class, and one asset class gives you a return of say 50% in a year, and the second asset class doesn't go anywhere. So after the year ends, what you do is suppose it's 50% and now it's 50 rupees, and now the asset class that has outperformed has become 75.
Sure.
So now 100 has become 125.
Right.
So what you do is you sell 12 and a half of the asset class that has outperformed and add it to the asset class that hasn't performed. So that you again make it 50-50.
I think Meb Faber does more or less something on the same lines. He divides it on the geography basis.
Yeah, I'm talking about two asset class. You can divide this asset class into 5 asset class. You can do it across. So emerging market investing is all. So those guys, and that's how those emerging market ETFs are important. They don't invest in a company in India.
Right.
They would invest in an ETF in India.
Right.
So you mentioned Swensen, but he has been very popular in saying that it's not only like 20% or 30%. He said 100% of my returns comes from only portfolio allocation, and not my returns. He has very strongly propagated that fact that stock selection per se is not less important. It's not important at all.
So I haven't gone to the other extreme. So one is that he has a portfolio scale where he can scout the global market.
Right.
So like at this point, if I say that I'm bullish on oil, so how do I build a position on oil, which is like a 5-year call?
Right.
So I don't have the wherewithal to have those kind of exposures.
Yeah,
sure.
So I was having this discussion with Srini, who is the UCLA Endowment Fund CIO. Actually, he came to MDI very recently for a lecture. Okay. So we met him and we were having the discussion. So he said a lot of this kind of endowment investing is decided by the asset liability match, and then the allocation becomes important. So for a smaller endowment fund, it will become very difficult for them to do that kind of a diversified allocation strategy because the liability won't be.
So it's a thought process, and I'll just try to highlight how I incorporated it. So what I've done is that I review my net worth, say it's 100, and then I've decided I want to idle, say 60% has to be equity, 25% has to be debt, 10% has to be real estate, and 5% is cash or cash equivalents.
Sure.
So these are the 4 asset classes for me.
Sure.
Right.
And then I do a review every 3 months and see ideal position is this, but on the current market prices where each of these asset classes sit, the allocation is there. And once I do that review, I know that okay, I am overweight on equity. Now I want to shift money out of equity. So, but real estate is very lumpy. To decrease or increase doesn't work that way easily. But at least on the back of the mind, I know that I now want to make an investment on real estate, or I want to exit one part of my real estate.
Fair enough.
So I've honestly done this for the last 4 years, and it's been really helpful in the sense that it allows me to sleep better at night.
Yeah. You live a very balanced life at least. No one stock can change your fortune, so to speak.
Yeah, I think
that's in the negative side. That
So on the positives, so one is the other thing is the return expectation. One of the things having trying to do risk arbitrage is another very interesting insight that I've got, which I think has been hugely helpful to me is when I used to do risk arbitrage and would have return expectations of say at least this year to yaar 30% आना ही चाहिए.
right.
That will and I started with that only. That what it made me do was take much more riskier decisions.
Yeah.
Say I would try to anticipate an open offer. So if a news report would come and I would say that in all probabilities an open offer aa raha hai, chalo position डालो. Now what I realized is 9 out of 10 times nothing happened.
Right.
And then when I would face a loss in that trade and then exit. So and then again there's another guy who's been very helpful in formulating this strategy for me. He said that why don't you keep your return expectations lower? Right. Say you want to play 15 to 18%.
Right.
But now look for trades where there is a high surety of getting those returns.
Right.
And once in a while you'll get a positive accident. So having said कि मेरा threshold अब 18% है,
right.
There's not been a single year where I've been less than 28% for the last 4 years.
Beautiful.
So this is a very interesting, because if you are looking at rationalizing your return expectations, it will allow you not to take too many risks.
No, this makes sense. Actually, there's a lot of cricket analogy in this as well. If you go out to set a total, and if you're going to put it in your mind that this is a very friendly batting wicket, let's give them a target of 400. You're going to set that's like too stiff a target, and you'll take stupid risk and
you'll
end up getting
out from the first ball. So you won't even spend an over.
Yeah, you'll end up at 180 or something.
Yeah. So I have the interview also.
Okay, the sort of.
Yeah.
So interesting.
So that's some of the insights that have come through over time. So I'm pretty comfortable with where things are now under the skins. Because I'm on cash, I'm not too worried about the volatility in the market.
If I may ask, who is the person who guided you on this strategy?
So this is a guy called Nikhil Gupta.